I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. High Yield Bonds by Theodore Barnhill is a comprehensive guide that provides an in-depth understanding of high yield, or junk bonds. The book covers various aspects of high yield bonds, including their history, features, risks, and advantages. The author starts by explaining the concept of high yield bonds and how they differ from investment-grade bonds. He goes on to explore the history of high yield bonds and how they gained popularity in the 1980s. The book also covers the characteristics of high yield bonds, such as their higher yield and credit rating, and why investors are attracted to them. Theodore Barnhill provides a thorough analysis of the risks involved in high yield bond investing, such as credit risk, interest rate risk, and liquidity risk. He also discusses the various factors that can affect the performance of high yield bonds, such as economic conditions and company-specific factors. The book also delves into the different types of high yield bonds, such as secured and unsecured bonds, and how they differ from each other. Theodore Barnhill also provides an overview of the high yield bond market and the different players involved, such as issuers, underwriters, and investors. One of the strengths of this book is that it provides practical advice on how to invest in high yield bonds. Theodore Barnhill explains how to conduct credit analysis and how to assess the creditworthiness of companies issuing high yield bonds. He also offers tips on how to build a diversified high yield bond portfolio and manage risks effectively. Overall, High Yield Bonds by Theodore Barnhill is an excellent resource for anyone looking to understand high yield bonds and how to invest in them. The book is well written and easy to understand, and it provides valuable insights into the high yield bond market. Point 1 in the book, High Yield Bonds by Theodore Barnhill explains that high yield bonds offer a higher yield but carry more risk than investment-grade bonds. Essentially, when companies or organizations need to raise capital, they may issue bonds to investors. Bonds are essentially IOUs, where the issuer agrees to pay the investor interest for the life of the bond and return the principal amount at the bond's maturity. Investment-grade bonds are issued by companies with strong credit ratings, indicating that the issuer is likely to be able to repay the bond's principal and interest. In contrast, high-yield bonds are issued by companies with lower credit ratings or that are in a riskier financial position, which makes them more likely to default on their payments. Because high-yield bonds carry a higher risk of default, investors demand a higher yield to compensate for the additional risk. The higher yield can make high-yield bonds an attractive investment for investors seeking higher returns. However, the risk of default means that investing in high-yield bonds requires careful analysis and risk management. Understanding the risks and rewards of investing in high-yield bonds is essential for building a well-diversified portfolio. Point 2 in the book, High Yield Bonds by Theodore Barnhill explains that the high-yield bond market emerged in the 1980s and has since become a popular asset class for investors seeking higher returns. During the 1980s, there was a surge in corporate takeovers, mergers, and acquisitions, and companies needed to raise large amounts of capital quickly. However, traditional sources of funding, such as bank loans and investment-grade bonds, were not always available or sufficient. To meet this demand for financing, investment bankers started to package together high-yield bonds issued by riskier companies and sell them as a single package to investors. This new market for high-yield bonds offered investors the opportunity to earn higher yields than traditional investment-grade bonds. Despite the risks associated with investing in high-yield bonds, the potential for higher returns was attractive to investors, and the high-yield bond market grew rapidly. Today, the high-yield bond market has become an established asset class and is widely used by investors seeking to diversify their portfolios and earn higher returns. The market has also evolved, with a greater variety of issuers, including non-US companies and private equity firms. The high-yield bond market is now an integral part of the global capital markets, and an important source of financing for many companies. Point 3 in the book, High-Yield Bonds, by Theodore Barnhill explains that investing in high-yield bonds involves various risks, including credit risk, interest rate risk, and liquidity risk, which require careful analysis and management. Credit risk is the risk of default by the issuer of the bond, and it is one of the most significant risks associated with high-yield bonds. Because high-yield bonds are issued by companies with lower credit ratings, or that are in a riskier financial position, there is a higher likelihood of default. To manage this risk, investors need to analyze the creditworthiness of the issuer and assess the likelihood of default. Interest rate risk is the risk of fluctuations in interest rates that can affect the value of the bond. When interest rates rise, the value of existing bonds decreases, and when interest rates fall, the value of existing bonds increases. To manage this risk, investors need to consider the interest rate environment and adjust their portfolios accordingly. Liquidity risk is the risk of not being able to sell a bond when needed. High-yield bonds may have limited liquidity because they are not as widely traded as investment-grade bonds. To manage this risk, investors need to consider the liquidity of the bond and the market in which it trades. Managing these risks requires careful analysis and ongoing monitoring of the high-yield bond portfolio. Investors should diversify their holdings across different issuers, sectors, and maturities to reduce concentration risk. They should also consider the duration of the bonds they hold and adjust their portfolios in response to changes in market conditions. Point 4 in the book, High-Yield Bonds, by Theodore Barnhill explains that high-yield bonds can play a useful role in a well-diversified investment portfolio, but investors need to carefully consider their investment goals, risk tolerance, and overall investment strategy before investing. High-yield bonds can provide higher yields than investment-grade bonds, which can be attractive to investors seeking higher returns. Additionally, high-yield bonds can offer diversification benefits because they tend to have a low correlation with other asset classes, such as stocks and investment-grade bonds. However, high-yield bonds also carry significant risks, as discussed in Point 3. Investing in high-yield bonds requires careful analysis and risk management. Investors should consider their overall investment strategy, investment goals, and risk tolerance before investing in high-yield bonds. Investors should also consider the size of their portfolio, as high-yield bonds may not be suitable for all investors. High-yield bonds tend to have lower liquidity than investment-grade bonds, and they may be more volatile, which can make them unsuitable for investors who require a high degree of liquidity or who cannot tolerate significant fluctuations in their portfolio value. Ultimately, the decision to invest in high-yield bonds should be based on a thorough understanding of the risks and rewards of investing in this asset class, as well as an investor's overall investment strategy and risk tolerance. Point 5 in the book, High-Yield Bonds, by Theodore Barnhill explains that the high-yield bond market is subject to various macroeconomic and market-related factors that can impact its performance, and investors need to be aware of these factors when investing in high-yield bonds. One of the key macroeconomic factors that can impact the high-yield bond market is the overall state of the economy. In general, when the economy is growing and expanding, the high-yield bond market tends to perform well. However, when the economy is in a recession or contracting, the high-yield bond market may experience a decline in performance. Another macroeconomic factor that can impact the high-yield bond market is inflation. Inflation can cause interest rates to rise, which can negatively impact the performance of high-yield bonds. When interest rates rise, the value of existing high-yield bonds decreases, which can lead to a decline in the value of the portfolio. Market-related factors that can impact the high-yield bond market include changes in investor sentiment and changes in credit spreads. Changes in investor sentiment can lead to changes in demand for high-yield bonds, which can impact their performance. Additionally, changes in credit spreads, which reflect the difference in yield between high-yield bonds and investment-grade bonds, can impact the performance of high-yield bonds. To manage the impact of these macroeconomic and market-related factors on their high-yield bond portfolios, investors need to carefully monitor the market and adjust their portfolios accordingly. This may involve rebalancing the portfolio, adjusting the allocation of assets, and considering different investment strategies based on changing market conditions. Additionally, investors need to have a long-term investment strategy and avoid making hasty decisions based on short-term market fluctuations. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.